Hey investors, Joe here. Welcome to Joe's Investment Express. Well, it felt like the good old days, didn't it, with Tesla up over 7%. And there are quite a few stocks breaking out and more stocks setting up nicely into bases. But let me tell you, we still need to be really careful right now. And we need to just tiptoe into the pool and not dive in head first, because we have not seen a follow-through day yet. And the market is very much news driven and can change on a dime. If you don't know what a follow-through day is, I'm going to show you shortly. Let's look at the agenda. All right, here's our agenda for today, and I'm going to try to get this done in 15 minutes. So first of all, like I said, many stocks are breaking out and in bases, and that is decidedly bullish, and we do not have to wait for a follow-through day to begin buying. But until we see a follow-through day, we really need to just be doing very small pilot buys. And as always, increasing our positions incrementally. We want to see a follow-through day Tuesday through Friday. I'll talk more about that in just a minute. Of course, we got to look at Tesla and its big move today. But all it's not golden. There's a big overhang looming above us. And I want to show you three charts that are quite actionable. MNRL, IGT, and MGY. By actionable, I mean they are buys tomorrow or very soon, at least in my book. And let me show you a handful of breakouts. Stocks, instead of breaking out and squatting and reversing intraday, we are seeing some really strong breakouts and on big volume, closing near their highs, which is really good for a good indicator of the market's health. And if we have time, I'm going to show you why you use sell stops. Poor Morgan Stanley, which I had such high hopes for, is looking like it is not looking good, folks. We will take a look if we get a chance. And let me end this video with a great little tip from, I think, the world's greatest living investor, Mark Minervini. Before we go further, though, let me just remind you, this is not for financial advice. This is just for entertainment. Just for education, and I am not a financial advisor. I have been investing for 25 years, since 1996. I think that's 25. Well, right about 25. So let's see. The charts I'll be showing you today are from MarketSmith and Stock Charts. This is a MarketSmith chart of the S&P 500. Now, here's what I mean when we talk about waiting for a follow-through day. Here's this huge reversal day on the Ukraine invasion news. So that's day one of the market rally attempt. And so then the follow-through day, you ignore the next couple days, and the follow-through day takes place on days 4 through 7. It can take place after 4-7 up to day 11, but it's has a much smaller chance of succeeding. So this is day one. Friday was day 2. Today was day 3. So now, Tuesday through Friday, what we want to see is an up day above right here, and we want to see big volume. We want to see volume bigger than today, which is going to be tough because today was a big volume day. What will signal that the rally attempt has failed is if we undercut this most recent low, and that's going to be hard to do because that is way down there. That's one reason I have a feeling the bottom is in, but let's not just hope and speculate. Let's let the chart tell us the condition of the market. All right, now let me show you a few. Oh, let's look at Tesla, of course, first. All right, now here's the Tesla chart, and I know you guys are excited, and I am too. It is so nice to see it. I'm heading back in the right direction. This is the one-year chart. Here's the 9-month base. Here is the Adam and Eve bottom, the big breakout on the third quarter news, the Bucky and Bronco action and decline from Elon selling his shares, and the general risk off of the tech area of the market. And we saw the bounce off the bottom exactly at 700, and now it is rallied up 25%. So congrats to all of you who got in down there near 700. I was not one of them. I missed it, as I told you a few days earlier. Now, if you are long and strong on this stock, if you are doing a multi-year hold, I think that's great. Keep doing what you're doing. Keep buying a share or two each month, etc. If you are swing trading this, or planning to be in for a shorter period of time, then you really want to be really careful here, because one, this is up 25% off its low in 3 days. Increasingly short-time traders are going to start bailing out. And two, there's a ton of overhead supply to our immediate left. When you have supply, you want it to be as far to the left as possible, and it is about as close as it can get. So as we get closer and closer to 900, which is where this supply starts, the investors who bought in here are going to be thanking their lucky stars that they are at even money, and they are going to start selling. And the astute investors like us who know about this phenomenon are going to start selling in anticipation of that, which causes more supply coming into the market than demand. And it's probably going to stall out here. Now, what we want to see is for it to stall out and make some sort of handle, or for it to pull back maybe about a third of the way, no more than half of the way, and then start moseying back up. That would be really good to see. If it falls hard, obviously we don't want to see that. So let's, you do what you want with your money, but this is not a buy right now for me. I want to see this handle develop, or I want to see a natural reaction where it bounces off this resistance and then makes another run. Let's look at the fundamentals really quick. So this is a chart from stockcharts.com. And this is the charting service I use for my fundamentals, MarketSmith. It gives you an amazing array of numbers that would take, hours to tabulate, and it's all here right in front of us. One of the things I really like is it shows you the relative strength. The stock in comparison to the S&P 500, the relative strength is 84, so it's stronger than 84% of the stocks, which is good, not great. Also, you want to see the relative strength line turning up, and it's still pretty flat. So that is neutral on that. Now let me slide these numbers over so you can see them here. All right. Oh, 1 second. Okay, so we have the good, and I guess we have the bad. The good, for a big cap, these numbers are just phenomenal. Look at the revenue. You're in the 30s and 40s and 70s and 90s and 50s, and most recently in the 60% growth range. That is spectacular for a stock with a market cap of $900 billion. And income is growing triple digits. Last quarter, it was up 218%. And if you look at the yearly earnings per share, it's going from 7 in 2021 to 11 in 2022. No dividend, of course. Now, this is the scary thing. PE ratio is still 119. And while it deserves to have a higher PE ratio than many of the other stocks because of its disruptive nature, one could argue that in this risk-off environment that this PE ratio is still pretty scary and will remain so unless we see some sideways action and until the next earnings report comes out. Now here's a stock that is very actionable. I plan on buying this tomorrow. If it opens to the upside, Brigham Minerals, MNRL, you'll notice it's right here at all-time highs, and relative strength line is at 94 and turning upwards, which is a good sign. The numbers are really strong here. This is an energy stock, by the way. You've got a yield, a dividend of almost 4%. That'll keep investors invested. Revenue, 200%, 82, 100% growth, and EPS growth, also triple digits. And the PE ratio is 20. Now, granted, this is not an innovative tech stock, but obviously the PE ratio is 5 times less than Tesla, which makes it, a better value in some people's mind. And let's look at this was the MarketSmith chart. Let's look at the stock charts version now for a little bit more of a close-up. As you can see, it's just been building out. The market has been bleeding off and falling precipitously, and MNRL has been moving sideways and getting tighter and tighter. That huge down day, it barely even caused a blip in the chart. And now today, which is Monday, is just tickling not the all-time high, but tickling above this supply here. So if it opens up to the, and that was on good volume, so if it opens up to the upside, I'm going to put in a pretty decent size buy tomorrow, and I'm going to put my stop right under here beneath the tail end of these two candles. That'll be about 6%. This is the 50-day exponential moving average. Now we have a little supply over here, but not a lot. This is where most of the supply is located. Chances are what I expect will happen, barring a really shaky day in the market tomorrow, is we'll see it get up here to 23.5, and then maybe make a handle, and then if it breaks out again, then we could do a follow-on position. That's what I expect to happen. Here's one more actionable stock that you might want to make a move on tomorrow. International Game Technology, IGT, relative strength rating is 96. Now earnings is coming up, so you might want to wait for earnings or do a very small position here. I'm actually already in this stock and I have a little bit of cushion, so I'm going to hold it through earnings. Let's look at the fundamentals. Really good. You got a dividend of 2.6%. You've got a little bit of erratic revenue, but 25.74, 21%. And EPS was spotty, but most recently it was up over 100%, 121. It did lose money in 2020. It's supposed to make $1.33 in 2021. Now let's look at the stock charts chart. Now this is a classic, what Minervini calls a VCP pattern. Each of these contractions gets smaller and smaller. You can see that with the green bars here. Large, medium, small. And so I got in right here. We had the bounce, and then I got in right about here. And now as you can see, much like the previous chart, MNRL, it is just making a new high and clearing this resistance. Now this isn't quite as tight. So like I said, I'm already in this, but if we could see it build a handle here, or make a small candle to the upside, you could put in a smaller position here, and then let's hope for another handle to build out and then a breakout of this larger pattern. This is a little bit of a deep base, but given the rough nature of the market, I think we can forgive it for that. Here's one more actionable chart, MGY Magnolia, oil and gas. Relative strength is 98, which is phenomenal. Right here at all-time highs where there's no overhead supply, and numbers are great. Triple-digit revenues, triple-digit EPS, 1.3% yield. It's making money. PE ratio of 9, which is pretty darn cheap. And if you look at the chart, you got a nice prior uptrend. You've got a nice double bottom base, which squatted. These squats have been happening all year long because of the shakiness of the market. But today we got a nice breakout. So it's just a little bit extended here. It would have been great to buy it this morning. And now it's right up here against a final level of supply. So let's wait and let's let it clear this resistance, or let's let it make another little handle. Let's let it pull back a couple percent and then make another run. And then we can take a stab at it. Small short stops, I would put your stop down here just above 20. And if you get stopped out, you get stopped out. You can always jump back in. Now I just want to show you these spectacular breakouts. So early in the year, we saw a lot of this, right, where it got near its breakout point and rolled over. But potash, IPI, as you can see, it is was up 10% today. 3 days of big volume. That is a really strong breakout. I actually sold it the day before because I was worried that it was going to roll over like stocks have been doing, but it doesn't look like it. Now this right side is pretty compressed, so it should come back and retest the upper lip of this cup. So don't chase this here. Wait for it to do a natural reaction and then catch it when it starts going up. Again, if that makes sense. The General Dynamics, GD, I told you guys about this one maybe a week or so ago as a potential potential military defense play when the Ukraine stuff heated up, and I hope that you had a chance to get into it. I got into it, not a big enough position. Isn't that how it is? When things go right, you always wish you'd bought a bigger position. But Look at this volume. It is just tremendously huge. I don't know what else to say. Two huge breakout days. And so we are extended. Do not FOMO into this thing. But if we can get a pullback at least to this 21-day exponential moving average, or preferably close to this 50-day exponential moving average, then you could still get in. Let's look at the fundamentals real quick. Okay, and here's GD from on the MarketSmith, 95 relative strength. Wow, numbers are really spotty. Revenue is single digits. That's pretty ugly. And EPS is ugly as well. But as you can see, it's making a little bit more money each year, $12 in 2022, 2% yield. And the chart's not lying, right? They are making big money with the war, which is sad to say, but that is what is happening. Let's see an AMP. This is one of my big picks to be winners for the year. This is makes biological products, biotechnical projects, generic, injectable, inhalation, and intranasal products. Numbers are really strong, as you can see. 22, 18, 34% revenue, triple digit EPS last quarter, PE ratio of only 26, RS line of 98. And so this is extended. It's about 15% above its breakout mark. 15% if you drew a line right across here at about 26. But fortunately for us, since we're not in the stock, at least I'm not, it pulled out back pretty hard today. This is called a tweezer pattern in Japanese candlesticks. And this indicates generally that it's going to keep going down. Although if the general market does a follow-through day tomorrow, the next day, it might not keep going down. But if we can see it pull back to the 21-day exponential again and then start to swing up again, I would feel very comfortable buying this one. And like I said, I think this might be one of the big winners for 2022. Here's another big breakout OVV. I'm not going to spend much time on this one because I'm already over. I was supposed to do 15 minutes and it's going to be 20, but you can see the huge breakout on almost 11% on huge volume today. Lastly, poor Morgan Stanley. Morgan Stanley had everything going for it. Good numbers, nice tight base, increasing interest rates, but money is rotating out of the financials. And as you can see, it had a breakout that failed after just 5%, and now it's undercut its 200-day exponential moving average, and it came back up and it tested. So this was support, and once support fails, it becomes resistance, and it came up, it tested right at the resistance and rolled over, and now it is trapped. There is tons of overhead supply. I suspect it's going to wallow down here for quite a while. So if you bought the breakout and you had your stop at 8% or less, then you got out up here at 102 and you're not trapped down here at 90. And that, my friends, is why we use stops. It's like wearing your seatbelt. It's an insurance policy. And let me just end today's little session with the tip from Mark Minervini, who I think is the best swing trader there is. And he says, never buy a stock under the 200-day moving average. Nothing good happens under there. So when you're thinking about bottom fishing, look and see if the price is above the 200-day moving average. If it's not, I would strongly recommend you wait until it is. All right, let me know your comments on the stocks in the video today. And give this video a like if you got something out of it. And I will try to check in tomorrow. Take care, everybody.